Welcome to the deep dive. Today, we're cutting through the noise of the stock market. We're going to dive into something that sounds simple, but is actually, well, profoundly difficult. And that's the idea that financial success isn't really about how high your IQ is. It's not about complex math. It's fundamentally about character.
That's exactly right. And that's the core philosophy, really, that's driving our discussion today. We're unpacking the, you could say, internal wisdom of Benjamin Graham, his book, The Intelligent Investor. It's just the cornerstone of value investing. And what's really remarkable, looking back, is how prophetic it still feels.
Yeah, it really does.
Especially the warnings he gave about market enthusiasm. I mean, reading it now feels like he was writing a precise forecast for, say, the dot-com bubble and the crashes that followed.
Absolutely. So the material we're drawing on for this deep dive, it's based on key excerpts from Graham's work, plus some modern commentary and analysis that applies those principles, through more recent history. Our mission here is pretty direct. We want to extract that pure, distilled framework for disciplined investing, help you shift from reacting emotionally like a speculator to acting rationally like a business owner.
And Graham really came to this philosophy through some hard, expensive lessons. You remember his early days on Wall Street back in the 1910s?
Vaguely, yeah. He had some initial big win, didn't he?
Oh, yeah. Spectacular initial success. He generated a jaw-dropping 250% return on Savile Tire's first day of trading. This was back in 1919.
Wow. 250% on day one. That's stunning.
Was
there a catch?
A huge catch. That victory was followed by an immediate, brutal reversal.
Oh.
Exactly. Within just a few months, that supposed success completely vanished. Savile Tire, exposed as a complete fraud. The stock became worthless.
Ouch. That kind of whiplash triumph, then disaster, must have shaped his thinking profoundly.
It absolutely cemented his lifetime focus on intrinsic value over just hype. It forces you, as you said, to look beneath the surface.
And it explains why he became such a relentless researcher, right? Almost microscopic in his analysis, like that Northern Pipeline Company example from, 1925?
That's a perfect example, yeah. This wasn't some hot growth stock everyone was talking about. It was pure, meticulous digging.
So what did he find?
Well, he found the company's stock trading for about $65 per share, but then he dug into the balance sheet, really dug in, and discovered the company held at least $80 per share in high-quality bonds, right there in its treasury.
$80 in bonds for a stock selling at 65.
Exactly. He realized the market was valuing the actual pipeline operations at negative $15 per share. It made no sense.
So obviously he bought it. That asset backing was a huge safety cushion.
He did, but he didn't just sit on it passively. This is where you see the early signs of the activist investor.
Ah, okay. So he pushed them.
Yeah, persistently, but politely, apparently. He pestered management, basically saying, look, the market is ignoring the real value here. You need to do something about this hidden wealth.
And did it work?
It took 3 years, but yeah, he eventually sold his shares for $110. So that's not just finding value. It's about applying rational business sense to the stock market.
It also really speaks to his character, doesn't it? So sources mention this idea, his third imperative, generosity of ideas, time, and spirit. He wasn't just trying to make a buck.
No, not at all. He wasn't trying to corner the market or keep secrets. He genuinely wanted to teach others how to succeed, how to avoid the pitfalls he had seen.
Like a mentor, planting trees for others, as they say.
That's precisely why his influence lasts. He aimed for clarity, for sound counsel, for the average person trying to invest sensibly.
Okay, so this brings us to the key question for today's deep dive. If intelligence is the key, what exactly did Graham mean by an intelligent investor? And why is it so much about character, emotional control, discipline, and not just, being good at math?
Let's dive right into that definition. Because you're right, it's the foundation for everything else Graham taught. #investor and the speculative trap.
Right, because I think most people, when they hear intelligent investor, they picture some kind of math whiz, maybe someone with a PhD running complex models.
And Graham just flat out dismisses that completely. The term intelligent investor, for him, has basically zero correlation with IQ scores or fancy degrees or even mathematical ability.
Zero.
Pretty much. He defines investment intelligence as a trait that's more of the character than of the brain.
Okay, so what are those character traits then? The ones that are apparently more important than raw analytical skill?
Well, they really boil down to patience, discipline. Being eager to learn, sure, that helps. But mostly it's about being able to harness your emotions.
Controlling the fear and greed.
Exactly. That plagued the general public, especially in markets. And maybe the most important part, Having the willingness, the guts, really, to think for yourself, to resist that powerful urge to just follow the crowd.
Yeah, that makes sense. Because even if you have the perfect analysis, if you don't have that emotional control, the first market dip will send you running for the exits,
Right.
selling perfectly good holdings at a loss.
Precisely. And that lack of discipline, that emotional reaction, is what leads people straight into what Graham called the speculative trap.
Ah, the big distinction, investment versus speculation.
It's an incredibly rigid, critical distinction for him. And it's a line that Wall Street, let's be honest, routinely blurs, often, to the detriment of the average person.
Okay, let's nail down that distinction
Right.
formally. What did Graham say is an investment?
Right. An investment is defined very specifically. It's an operation that, and this is key, on thorough analysis, offers safety of principal and a satisfactory return.
Thorough analysis, safety of principal, satisfactory return. All three.
You absolutely must meet all three criteria. Deep analysis first, then ensuring your capital is safe, then looking for a reasonable expected return.
And if an operation doesn't meet all three?
Then it's speculation, period. Everything else falls into that category.
So things like using margin accounts.
Definitely speculation, according to Graham. You're borrowing money to buy stocks.
Yeah.
You are automatically speculating, buying some hot new IPO just because the price is going crazy.
Speculation? Or gambling, maybe?
Pretty much, you're relying on the hope that somebody else, some greater fool, will pay even more later. You're not relying on the actual underlying value of the business itself.
Okay, but here's the slightly cynical question then. If the distinction is so clear, why does the financial industry seem to encourage blurring these lines? Why are we always hearing about investing in the latest, hot tech stock or crypto coin?
Well, because, frankly, it's a better business model for them. It just is.
How so?
Think about it. People who invest with discipline, patience, sound valuation, they mostly make money for themselves. They don't trade very often.
Right, buy and hold, basically.
More or less. But people who speculate, who chase performance, jump in and out, trade constantly, they make a lot of money for their brokers, for the institutions handling those trades. The whole market machine, in many ways, is geared towards volatility and turnover, not patient ownership.
It reminds me of the quote you mentioned earlier about the language used, reckless investors.
Ah, yes. Our sources point that out. The phrase reckless investors is just a laughable contradiction in terms. It's like saying spendthrift misers. It makes no sense.
Huh, true.
And, if the misuse of that word investor wasn't so mischievous, because it really does mislead people into taking huge risks while thinking they're being prudent, it would actually be funny.
Let's look at some historical proof then. Proof that ignoring this investment versus speculation distinction is, well, disastrous. Graham himself updated his work after the big market shock as 1969-1970.
Oh yeah, that 69-70 period was a really painful reality check for a whole generation of investors. Leading common stocks, the blue chips, dropped about 35%. That's a serious hit.
And what illusion did that shatter?
It definitively shattered the belief that had really taken hold in the go-go 60s. This illusion that you could just buy the stock of any large, famous corporation anytime at any price, and you'd be guaranteed to make a profit.
Because it was a big name.
Exactly. It taught a hard lesson. Even the bluest of blue chips can lead to catastrophic losses if you overpay wildly for them.
And presumably the damage was even worse for the newer, more speculative stocks, the ones people had chased with enthusiasm.
Disproportionately worse, yes. The secondary and third line stocks got absolutely hammered. And the lesson Graham drew from that was really pointed, he said. Enthusiasm may be necessary for great accomplishments elsewhere. On Wall Street, it almost invariably leads to disaster.
Enthusiasm is great for building a company, maybe, but terrible for valuing one.
Precisely. And we saw this exact same cycle play out again with terrifying precision during the dot-com era, didn't we?
Oh, absolutely. The quotes from 1999 in the source material.
Yeah.
They sound identical to the misplaced optimism of the late 60s.
The denial was just fierce. You had CEOs, fund managers waving away any talk of a bubble, saying things like, oh, it's not a mania, look at the outright growth.
Or that famous strategist declaring it's a new world order.
Right. Suggesting that the old rules of valuation, things like earnings and assets, were somehow obsolete because, well, technology changes everything.
Famous last words.
Yeah.
And the market's response to that new world order was just savage when the bubble burst.
The destruction of capital for those who had speculated, who bought into the hype, was swift and, in many cases, total.
Give us an example, that Monument Internet Fund.
Oh, that's a classic. A perfect case of just chasing the hot sector. If you put $10,000 into that fund, riding the enthusiasm of 1999, by the end of 2002, your $10,000 would have shrunk to only about $2,000.
Wow.
An 80% loss.
And it gets worse. Another famous hotshot fund from that era, one that had pulled in over $100 million in assets. Well, if you'd put $10,000 in that one at the peak, you'd have been left with just $1,195 by 2002.
That's nearly a 90% wipeout in just 3 years. It really hammers home Graham's point, doesn't it? Obvious prospects for physical growth, like the internet expanding, do not automatically translate into obvious profits for investors. By the time the growth story is common knowledge, the price usually already reflects and often drastically overstates those expectations.
So, okay, you start by making that crucial distinction. Am I investing or am I speculating? If you commit to investing, what's next? Graham says you have to choose a path, right?
Yes. Once you've decided to be an investor, not a speculator, the next step is committing to a rational path forward. And he's very clear about the options. Graham basically says there's really no effective middle ground here. You can't really dabble. You have to choose a clear role. You're either going to be a defensive investor or you're going to be an enterprising investor.
Defensive or enterprising. And trying to mix them or do a half-baked aggressive strategy, that's where you get into trouble.
Usually leads to the worst results, yeah. He strongly suggested that the vast majority of people anyone who lacks the time or maybe the inclination or even just the emotional temperament for really deep analysis, they should definitely choose the defensive or passive path.
Okay, so the goal for the defensive investor isn't to beat the market necessarily. It's what?
It's to achieve satisfactory results, decent returns, but with minimum effort and, crucially, minimum risk. And the way you do that is by setting up very clear, almost mechanical guardrails for yourself.
Right. Let's talk about those guardrails. What's the primary one?
Asset allocation.
That's the fundamental guiding rule. You divide your funds between high-grade bonds and high-grade common stocks, and you stick to a range.
A range?
Yes. Never less than 25% in stocks and never more than 75% in stocks. The standard kind of default division is 50-50.
And how does that work in practice? Well, if stocks become really cheap, objectively cheap, based on value metrics, you might increase your stock allocation up towards that 75% limit. If stocks become wildly expensive, like in a bubble, you systematically sell them down back towards the 25% minimum, putting the proceeds into bonds.
So it automatically forces you to buy low and sell high, more or less, without trying to predict the market's next move.
Exactly. It takes the guesswork, the forecasting out of it. It's a discipline.
Okay. And within that stock portion, the criteria for which stocks to buy are also super conservative, right? You can't just buy anything.
Oh, absolutely not. The defensive investor must stick to large, prominent, and very importantly, conservatively financed corporations, companies that have a long, uninterrupted record of paying dividends.
He gets pretty specific about the balance sheet requirements too, doesn't he?
He does. It reflects that deep focus on just rock-solid financial health. For industrial companies, the common stock equity, the book value, must represent at least half of the total capitalization.
Meaning not too much debt.
Right. Primarily financed by equity and retained earnings. For utilities or railroads, because their capital structures are different, that minimum equity level is 30%. But the intent is clear. Only by companies that are financially bulletproof.
And then there's the price constraint.
Yeah!
This seems crucial. It's like the first layer of the margin of safety we'll talk about later.
Yes, exactly. The defensive investor must limit themselves to buying stocks that are selling not too far above their tangible asset value, their book value. His example was, say, not more than 1/3 above book value.
That's a pretty tight constraint, especially in today's market sometimes.
It's a powerful constraint. It dictates that you must buy an interest in a real sound business for a rational asset-backed price.
I can see the psychological benefit there. If you know you bought a solid company at a price close to its liquidation value, essentially,
right,
then if the market price dips tomorrow, you can kind of shrug it off. You know the business itself is still sound. You own a piece of tangible value.
Exactly. It provides that essential psychological shield against what Graham called Mr. Market's tantrums, his mood swings.
Okay, so this defensive approach, it seems perfectly suited to some mechanical tools. The sources mentioned 3: investment funds, common trust funds, and one that's really effective, dollar cost averaging, or DCA.
DCA. It's brilliantly simple, almost deceptively so.
Explain how it works.
It just involves investing the exact same amount of money, say $500, on a regular schedule, maybe the first of every month, regardless of what the market price is doing.
So same dollar amount each time.
Right. And because your dollar amount is fixed, you automatically buy more shares when the market price is low, and you automatically buy fewer shares when the market price is high.
It seems almost too simple to be effective, but the historical results are pretty compelling, aren't they?
Yeah.
Even if you start at the absolute worst possible time.
Oh, the anecdote here is fantastic. It involves John J. Raskob, the General Motors tycoon, back in the late 1920s, right before the crash.
Right.
Raskob wrote an article famously titled, "Everybody Ought to Be Rich." And he promised that saving just $15 a month invested in good common stocks would compound into an estate worth $80,000 in 20 years.
Wow. $15 a month to $80,000. That sounds wildly optimistic, especially starting in 1929.
It was wildly optimistic. He was predicting market performance that just didn't happen, obviously. But here's the fascinating part. What if someone actually followed his prescription, started putting in exactly $15 a month right at the market peak in 1929, just before the Great Depression hit?
Okay, what would have happened 20 years later, say by 1948? They must have lost everything, right?
You'd think so. But if they stuck to the plan, religiously investing that $15 every month from 1929 all the way through to 1948, their total holdings would have been worth about $8,500.
Okay, $8,500 is a far cry from the promised $80,000, so a failure in that sense.
A huge failure compared to the promise, yes. But here's the crucial bit. That $8,500 still represented an 8% compounded annual return on their total investment over those 2 decades.
Wait, 8% per year. Starting at the peak of the mania, going through the worst depression in history.
Exactly. The consistency of the dollar cost averaging protected them. It smoothed out the volatility. It forced them to buy more shares when prices were dirt cheap during the Depression. It was the power of a consistent method over trying to predict or time the market. It still generated sound results.
That's phenomenal. DCA really insulates you from that emotional urge to just stop investing when things look terrifyingly bad.
It does. Now, let's quickly look at the alternative path, the enterprising investor. Graham is very clear here. This path is only for those willing to really devote significant time and effort. You have to treat investing like a serious business operation. It requires, in his words, a considerable knowledge of security values.
Right. Not for the faint of heart or the casually interested. And the core difficulty for this enterprising or aggressive investor is actually achieving those better than average results, isn't it?
That's the crux of it. To consistently beat the market average, your policies, your strategies have to meet 2 tough conditions. 1, they have to be inherently sound and promising based on logic and evidence.
Okay, makes sense.
And 2, and this is the tricky part, they have to not be popular on Wall Street.
Not popular. Why?
Because if a strategy is easy to understand, easy to implement, and has become widely adopted, well, the market has already factored it in.
Right.
The edge, the potential for outperformance, gets competed away.
So you need to find sound strategies that other people aren't doing or aren't doing correctly.
Exactly. The enterprising investor, this quasi-businessman, typically focuses on maybe 4 main areas where these unpopular opportunities might exist.
What are those 4 areas?
Okay, so number 1 is market timing, trying to buy broadly in low markets and sell in high markets. Very difficult, as we'll discuss. 2 is buying carefully chosen growth stocks, but with rigorous valuation, not just hype. 3 is buying bargain issues. These are stocks that are demonstrably cheap based on assets or earnings, like selling for less than their net working capital per share, real deep value stuff.
Okay.
And 4 is buying into special situations, things like merger arbitrage, liquidations, reorganizations. Though Graham noted even back then that competition was making these harder to profit from reliably.
Let's focus for a second on one of those bargain strategies.
Yeah.
The low multiplier idea. Buying the cheapest stocks based on a low price to earnings, or PE ratio.
Right, this was a classic Graham approach, developed partly to counter the popular Wall Street idea of just buying stocks because they were going up, the momentum stocks. Graham said, no, look for the unpopular low PE stocks that the market is ignoring or overly pessimistic about.
And historically, that often worked pretty well.
Often, yes. Because frequently you were buying fundamentally sound companies that were just temporarily out of favor. You were getting earnings power cheaply.
But crucially, the enterprising investor has to keep adapting, right? Our sources mention that this specific low PE strategy, when tested on its own during a specific period, late 68 to mid 71, It didn't work so well.
It proved quite disappointing, yes. And that failure is incredibly instructive.
Why? What does it teach us?
It demonstrates that as soon as even a relatively simple, powerful strategy like buy low PE stocks becomes somewhat known and followed, its effectiveness diminishes. The market adjusts. It means that just using one simple screen like low PE wasn't enough anymore.
So the aggressive investor always needs more.
Always needs multiple layers of analysis. Financial strength, asset backing, maybe management quality, dividend record. You need a combination of factors to find true bargains that the market hasn't already picked over.
Okay. This inherent difficulty, the fact that consistently beating the market is hard and forecasting price moves is nearly impossible. This is why Graham gave all investors, defensive or enterprising, his most powerful psychological tool, isn't it?
Absolutely. And it starts with accepting the near impossibility of market timing. Hashtag tag 3, psychology, market fluctuations, and the Mr. Market parable. Yeah, the first big psychological hurdle to overcome is just accepting the, frankly, utter futility of trying to consistently time the market based on forecasts.
And the track record of professional forecasters.
Yeah.
Well, it's pretty dismal, isn't it? We looked at the predictions right around the NASDAQ peak in March 2000.
Oh, it was a spectacle of misplaced confidence. I mean, literally on the very day the NASDAQ composite hit its all-time high, never to be seen again for 15 years, a very prominent, highly influential chief technical analyst was publicly predicting it would skyrocket further, up to 6,000 within the next year and a half.
Wow, instead of hitting 6,000, it absolutely cratered.
Completely cratered. And even later, think about 2001 when the economy was clearly sliding into recession. You still had a major Wall Street strategist forecasting the S&P 500 would finish the year way up at 650, the Dow at 13,000, while flat out denying a recession was even possible.
The market just doesn't care about forecasts, does it?
Not one bit. The intelligent investor has to recognize that these daily, weekly, monthly price fluctuations, they really only have one significant meaning for you.
Which is?
They offer an opportunity. An opportunity to buy wisely when prices fall sharply or to sell wisely when prices advance greatly. That's it.
And this core idea is just brilliantly captured in his famous Mr. Market parable. Can you walk us through that, really bring it to life for the listener?
Sure. Imagine you own a share in a private business. You have a partner in this business, and let's call him Mr. Market.
Okay, Mr. Market.
Now, Mr. Market is, well, he's not the most stable individual. He's profoundly manic depressive.
Okay.
Every single day, without fail, Mr. Market shows up at your office. And depending on his mood, he shouts out a price. He either offers to buy your share of the business from you, or he offers to sell you his share of the business.
And the price he quotes is totally based on how he feels that day.
Yeah.
Not necessarily the real value of the business.
Exactly. When he's feeling wildly euphoric, maybe he just read some good news, he quotes you an absurdly high price. He thinks the future is limitlessly rosy. But when he's panicked and depressed, maybe read some bad news, he quotes you a ridiculously low price, often way below what the business is actually worth. He's terrified, needs cash immediately, thinks the world is ending.
So the insight here is, you don't have to trade with him.
That's the deceptively simple genius of it. The true investor should only transact with Mr. Market when it clearly benefits them. If he quotes a ridiculously low price because he's panicking and you know the business is worth far more, you should happily buy his share. If he quotes a ludicrously high price because he's euphoric, you should happily sell him your share.
And the rest of the time, when his price is neither extremely high nor extremely low.
The rest of the time, the wise investor should just ignore him. Graham says you should essentially forget about the stock market and pay attention to his dividend returns and to the operating results of his companies.
So the value of your share in the business doesn't actually change just because your manic partner is having a mood swing and shouting a different price in the lobby.
Precisely. You let his moods create opportunities for you rather than letting his moods dictate your actions or feelings.
The market's absurdity, driven by this collective manic depressive behavior, is really what creates these chances. Let's look at that Chrysler example again.
Oh, Chrysler's history is just a perfect illustration of these wild emotional swings. Back in 1938, the stock was so despised, people said it was practically being given away, and still nobody wanted it.
Wow.
Then, fast forward about 2 decades to 1961, suddenly the public was clamoring for Chrysler shares, bidding them up to 30 times earnings, even though the company's recent earnings record was, frankly, pretty mediocre.
And what happened after that peak of enthusiasm?
Soon after that peak, the price collapsed, dropped by more than half, very quickly. That kind of extreme volatility From hated to loved, back to hated. That's almost purely emotional, not driven by rational changes in the business's long-term value.
And the examples from the dot-com bubble were even more stark, weren't they? Because many of those companies had no earnings history at all.
Exactly. Take Inktomai back in 2000. Mr. Market, completely fueled by euphoria about the internet's future, valued this tiny little technology company at $25 billion.
$25 billion for Inktomai.
And here's the truly amazing part. Inktomai had never made a dime of profit in its entire corporate life. In fact, it was losing money rapidly, burning through cash.
So the valuation was based purely on hope.
Purely on the intoxicating idea of future, infinite potential. The price had completely detached from any current business reality.
This kind of emotional overreaction starts to make more sense when you consider the psychological research our sources mentioned.
Yeah.
About how we feel gains versus losses.
Right. That's the core of loss aversion, a key concept in behavioral finance.
Mhm.
Neurologically, the pain we feel from a financial loss is drastically more intense than the pleasure we feel from an equivalent gain.
How much more intense?
The research suggests it's more than twice as intense. So losing $1,000 feels loss is drastic.
Yeah. About
The price had completely detached from any current business reality.
this kind of emotional overreaction starts to make more sense when you consider the psychological research our sources mentioned.
Yeah.
About how we feel gains versus losses.
Right. That's the core of loss aversion, a key concept in behavioral finance.
Mhm.
Neurologically, the pain we feel from a financial loss is drastically more intense than the pleasure we feel from an equivalent gain.
How much more intense?
The research suggests it's more than twice as intense. So losing $1,000 feels more than twice as bad as gaining $1,000 feels good.
Okay, I can see how that would warp decisions.
Absolutely. It explains why people panic and sell near the bottom. They're desperately trying to stop that intense pain of further loss. It also explains why people might refuse to buy more of a stock when it's cheap because they fear the short-term pain if it drops just a little bit more before recovering.
And this emotional reflex gets constantly poked and prodded by how the news media reports market moves, right? The Dow plunges 300 points. It sounds terrifying.
That framing is often deliberately manipulative, or at least context-free. If the Dow Jones average is sitting at, say, 30,000, then a 300-point drop is just a 1% move. It's basically noise, a minor vibration.
Like the weather report saying temperature plummets from 81 degrees to 80.
Exactly. You'd laugh at that. The intelligent investor must train themselves to think about market changes in percentage terms, relative terms, to avoid getting panicked by these minor, everyday jitters that headlines often exaggerate.
Graham even suggested, somewhat wryly, that investors might almost be better off if their stocks had no daily market quotation at all.
Right, because then they'd be spared the mental anguish caused him by other person's mistakes of judgment. Without the daily noise, you'd be forced to focus on what actually matters.
Which is?
The underlying business's results, its earnings, its assets, its dividends. Focusing on those internal results, the actual business reality, is the only way to properly apply Graham's single most vital concept.
The margin of safety.
The margin of safety, yes.
Okay, so if we had to boil down Graham's entire philosophy, his secret to sound investment, into just 3 words.
It would be margin of safety.
Margin of safety. It sounds simple, but let's unpack it. What is it exactly?
It is absolutely the single most important concept in all of value investing. Graham defined it as the favorable difference between the price you pay for a security and its indicated or appraised value.
The gap between price and value.
Precisely. The bigger the gap, the wider the margin.
But why is this concept so critical? Why isn't just buying something at fair value or slightly below good enough? Why the emphasis on a margin?
Because the margin of safety is your explicit, built-in protection against the uncertainties of the future. And the future is always uncertain in investing.
Right, you can't predict everything.
Exactly. The intelligent investor has to accept that they will make mistakes in their analysis. Their calculations won't be perfect. External events will happen. Luck might turn out to be worse than average. The margin is there specifically to absorb the impact of those inevitable errors and misfortunes.
So it's like a buffer zone, insurance against being wrong.
It's exactly that. Since, as Graham noted, uncertainty and investing are practically synonyms, you must build that insulation, that buffer, into your process from the start.
Okay, let's look at how this margin used to typically show up in the stock market under more traditional conditions. How did Graham calculate it?
Well, historically, a key way to see the margin was by comparing the expected earning power of stocks to the yield available on safe high-grade bonds.
Okay, give me an example.
You might reasonably expect a portfolio of sound common stocks, bought at a fair price, to have an earnings yield that's the inverse of the PE ratio of maybe 9% on your cost. At the same time, high-grade bonds might only be yielding 4%.
So 9% earnings yield on stocks versus 4% on bonds.
Right. That 5% difference, that extra earning power from the stocks, that was your margin of safety. Part of that 5% would typically be paid out to you as dividends, and the rest would be reinvested by the company to grow the business, hopefully increasing its value over time. That 5% cushion protected you against disappointments in earnings or fluctuations in the market.
Okay, that makes sense. But the sources highlight a major challenge that emerged in the early 1970s, a situation that really shook this traditional calculation.
Yes, this was a huge deal. By 1972, Graham observed a massive structural shift in the markets. Primarily due to rising inflation, bond interest rates had soared to levels previously unseen in peacetime. At the same time, stock valuations had also risen, meaning their earnings yields had fallen.
So the gap was closing.
The gap had virtually disappeared. In many cases, the expected earnings yield on representative stocks and the interest rate available on long-term bonds had essentially converged. They were roughly the same.
Uh-oh. That sounds like a serious red flag for the margin of safety concept.
It was a massive red flag. If the potential earning power of a stock is no higher than the guarantee rate you can get on a safe bond, well, where's your compensation for taking on the extra risk and uncertainty of stock ownership? Where's the margin?
It's gone.
It had vanished. Graham starkly recognized that in this specific market environment, investors were effectively being offered a negative margin of safety on common stocks compared to bonds.
Wow. Negative margin of safety.
Which is precisely why he cautioned very strongly against having a heavy allocation to stocks at that particular time. It underscores a critical point. The margin of safety isn't some magical property inherent in all stocks at all times. It's something the investor must actively demand and find through disciplined purchasing at the right price relative to value and alternatives.
This whole concept, demanding that margin, it beautifully explains why Graham's view of risk completely turns modern portfolio theory on its head, doesn't it? Warren Buffett had a great analogy for this paradox.
Oh, the dollar bill analogy?
That's just
Perfect. Buffett explained it something like this. If you buy a dollar bill for 60 cents, it's riskier than if you buy a dollar bill for 40 cents.
Wait, hang on. Say that again. Buying for 60 cents is riskier than buying for 40 cents. That sounds backward.
It sounds backward to conventional finance, yes. But he continues, but the expectation of reward is greater in the latter case, buying for 40 cents.
Okay, I need to wrap my head around that. Conventional wisdom, usually measured by something like beta, says volatility equals risk. A stock that has dropped from 60 cents to 40 cents is probably more volatile. So wouldn't standard finance theory say the 40-cent purchase is riskier?
That is the absolute crucial distinction. Graham, and Buffett following him, completely reject volatility, beta, as a useful measure of true investment risk. For them, risk is defined much more simply and fundamentally. It's the risk of suffering a permanent loss of capital, primarily caused by paying too much in the first place.
Okay, so if you buy the dollar bill for 40 cents.
You have a 60-cent margin of safety. The underlying value would have to fall by 60 cents before you actually start losing your principal. If you buy the dollar for 60 cents, you only have a 40-cent cushion.
So the cheaper the purchase price relative to the underlying intrinsic value, the lower the actual risk of permanent loss, and simultaneously, the greater the potential reward if the price eventually reflects the value.
Exactly. It's a complete inversion of the standard risk-reward curve taught in finance classes. The Washington Post Company example from 1973 is just the gold standard illustration of this.
What happened there?
Well, in the depths of the 73-74 bear market, Mr. Market, in one of his depressive fits, was valuing the entire Washington Post Company at just $80 million.
$80 million for the whole company.
The whole thing. But Graham and Buffett looked at its underlying assets, which included not just the iconic Washington Post newspaper, but also Newsweek magazine, several very profitable TV stations, and other properties, and they conservatively estimated that these assets, if sold off individually, were worth at least $400 million. Probably more.
Wow, so you could buy $400 million worth of assets for just $80 million in the stock market.
Right. That $320 million gap between price and value, that is an immense margin of safety. Even if the economy tanked further, even if some of their calculations were off, that huge buffer protected the investment.
And if the stock price had fallen even further, say to $40 million, beta would have gone through the roof,
Right.
signaling extreme risk.
Beta would have soared, absolutely, screaming danger, high risk, because of the increased volatility. But for the true value investor, what happened? The margin of safety just grew even wider, from $320 million to $360 million. The opportunity actually became less risky, in Graham's terms, because the potential for permanent loss shrunk even further, while the potential upside increased.
So true risk isn't volatility. It's the danger of overpaying for an asset, paying too much for quality, or worse, paying too much for just hope and hype.
Precisely. And understanding that true risk lies in overpayment brings us directly to what Graham saw as perhaps the most seductive and dangerous trap for almost every investor.
The allure of growth stock.
Exactly. The siren song of growth, #TechV. The perils of growth stocks and accounting games. Graham was just relentless on this point. He stated it very clearly. Obvious prospects for physical growth in a business do not translate into obvious profits for investors.
Why not? If a company is obviously growing fast, isn't that good?
It's good for the company, maybe. But by the time that growth is obvious to everyone, by the time it's the cover story on magazines, the stock price has usually already discounted and often wildly overshot all plausible future expectations. The good news is already more than priced in.
Right. The market anticipates. The history of technology is just littered with these kinds of cautionary tales, isn't it? Even with really great companies,
Yeah.
like Texas Instruments back in the day.
Oh, TI is a perfect example from the 60s growth stock mania. It was heralded as a true marvel of growth and innovation. But during its heyday, its stock price advanced 5 times faster than its actual profits did.
5 times faster.
Yeah. The price was reflecting expectations that were just mathematically impossible to sustain long term. So when earnings inevitably hit a bump and dropped about 50% from their peak, the stock price didn't just drop 50%, it plummeted by 4/5, wiped out 80% of its value.
Because the huge valuation premium evaporated.
Instantly. And we saw the exact same pattern repeat almost uncannily in the 1990s tech bubble. These massive price premiums paid for expected future growth are incredibly fragile,
Even for the best companies.
even for the giants. Microsoft, arguably one of the most successful companies in history, its stock still dropped 55.7% between 2000 and 2002. Cisco Systems, which had been this absolute darling, climbing 50-fold over 6 years based on seemingly endless growth expectations, it lost 76% of its value in that same 2000-2002 period.
Ouch, 76%.
The premium paid for that future growth just vanished into thin air when the market finally realized that even stunning growth can't justify an infinite or near infinite price.
You know, I find Graham's critique of the complex valuation methods often used for these high-growth stocks really fascinating.
Yeah.
His warning against mathematical over-elaboration.
Yes, he saw a profound paradox there, that mathematical gymnastics, the complex models, they tend to become most elaborate and theoretical, precisely in the situations where the underlying assumptions are least reliable and most uncertain.
Like trying to forecast growth rates decades into the future.
Exactly. When you try to put a precise present value on a company whose earnings are expected to grow at a very high rate, say, well above 8% or 10% annually for an indefinite period, you run headfirst into what he called the mathematical dilemma.
Okay, explain that dilemma. Why does assuming high, indefinite growth create a valuation impossibility?
Well, it's related to how you discount future cash flows back to their present value. The higher the assumed growth rate goes, especially if you assume it lasts forever, the larger those future projected earnings become relative to the discount rate you're using. If that assumed long-term growth rate actually exceeds your discount rate, mathematically, the formula spits out an infinite present value.
So the math literally breaks down and suggests the company is worth everything, an infinite amount.
Pretty much. And for Graham, that absurd result was a clear signal that you've completely departed from the realm of rational analysis and entered the land of fantasy.
So what was his advice? Stick to simpler math.
His advice was stern. Dependable calculations about intrinsic value should not require anything more complex than simple arithmetic or the most elementary algebra. If your analyst needs calculus or highly abstract, multi-stage, discounted cash flow models stretching decades out to justify the current stock price, the conclusion is almost certainly suspect, built on layers of uncertain assumptions. Keep it simple. Keep it grounded.
Okay, beyond just the valuation issues with growth stocks, the enterprising investor, the one doing the deep digging, also needs to be hyper-vigilant about accounting tricks, right? Ways managers can manipulate the numbers.
Absolutely. This is crucial for the enterprising investor who's looking beyond the simple defensive criteria. Graham highlighted several pitfalls. The first major warning sign is the use of big bath charges.
The big bath sounds cleansing, but probably isn't.
No, it's a deliberate bookkeeping gimmick. Management basically decides to dump every conceivable loss, every write-down, every restructuring cost, anything negative they can find, into one single massive charge, usually taken in an already bad year or quarter.
Yeah.
Okay, why would they do that? Why take all the pain at once?
The goal is purely to make all the subsequent years or quarters look fantastic by comparison. By clearing the decks, even modest future performance looks like a spectacular turnaround. LTV Corporation was a classic case back in the day, reporting a huge $4.3 million loss in just one 3-month period in 1969 by throwing everything in. Later, AMF had these long, confusing lists of write-offs from all sorts of random subsidiaries.
And these non-recurring charges, they sometimes recur, don't they?
They often have a nasty habit of recurring under different names, but the immediate effect of the big bath is that the next quarter's profits suddenly look amazing, which often helps justify big management bonuses for the apparent turnaround.
Sneaky. Okay, what's another key accounting pitfall to watch for? Something about cash flow.
Yes, specifically an addiction to OPM, other people's money.
Okay.
This refers to companies that become heavily reliant on constant infusions of external cash. This usually comes from either issuing a lot of new debt or continually selling new shares of stock. On the cash flow statement, this shows up prominently under cash from financing activities.
And why is that a danger sign? Isn't raising capital normal?
It can be normal, yes, but it becomes a huge danger sign when that financing cash is consistently needed just to keep the lights on, because the company's core operations aren't generating enough cash themselves.
Oh, so it's masking an underlying weakness in the actual business.
Precisely. Global Crossing and WorldCom, before their spectacular flameouts in the early 2000s, were textbook case studies in OPM addiction. They required these constant, massive injections of financing cash simply because their underlying telecom businesses weren't generating enough positive operating cash flow to fund their massive spending and debt payments.
So if a company can't fundamentally finance its own operations from its customers, relying on Wall Street for constant handouts is a very fragile situation.
Extremely fragile. It doesn't matter how good the reported earnings look if the cash isn't really coming from the business itself. Eventually, the financing window closes.
Okay, one last point on management behavior. That Graham warned about something that intentionally feeds speculative instincts. Stock splits.
Oh, Graham was particularly harsh on the repeated use of stock splits, especially when hyped breathlessly by management. He basically said companies that do this constantly treat their investors like dolts.
Because it doesn't actually change the value, right? It's just psychological manipulation. The old 2 nickels for a dime trick.
Exactly. 2 shares trading at $50 are not intrinsically worth 1 single cent, more than 1 share trading at $100. The total value of your holding is identical. Managers who constantly split their stock, often accompanied by breathless press releases, are doing it for purely promotional reasons.
Trying to make the stock look cheaper per share.
Yes, to make it seem more accessible, maybe encourage more trading, appeal to less sophisticated buyers. Graham saw it as management aiding and abetting the worst instincts of the investing public. They're fanning the flames of speculation rather than encouraging a focus on the long-term value of the business.
So an intelligent investor should actually be pretty skeptical of management that seems overly focused on stock splits and other promotional gimmicks.
Deeply skeptical. It suggests management might be more interested in the stock price than in the underlying business performance. #tag outro.
Wow. We've covered a remarkable amount of ground today, but what really strikes me is just the sheer timelessness, the relevance of Benjamin Graham's core principles. Whether you apply them back to the Great Depression, or the inflation of the 1970s, or the dot-com bust, the fundamental truths seem to hold.
They really do. The framework, I think, remains immutable. Financial intelligence, true investment intelligence, is fundamentally about discipline. It's about rigidly maintaining that distinction between investment and speculation.
Right. Don't gamble when you think you're investing.
Exactly. Then, choose a consistent, rational strategy, whether it's the defensive path or the enterprising one, and then, crucially, adhere to it with patience. Don't jump around.
And underpinning it all.
Underpinning everything is the margin of safety. Rely on it. Demand it. It's your shield against the inevitable uncertainties and your own fallibility.
And we saw the real-world cost of abandoning those rules, didn't we?
Yeah.
That data about mutual fund investors during the bubble years.
Yeah, that study covering 1998 through 2001 was just staggering. It showed that the average mutual fund investor, largely because they were trying to time the market chasing hot funds, selling after dips, actually underperformed the results of their own funds by a massive 4.7 percentage points annually.
4.7% per year. That's huge. That gap isn't bad luck. It's the cost of emotional decision-making, right? The price of abandoning discipline.
It's precisely the difference between earning a rational return based on the underlying investments and the damage inflicted by fear and greed by trying to outsmart Mr. Market. Which actually brings us neatly to our final, maybe provocative thought for today. It's rooted in philosophy, actually, in Pascal's wager, but applied to investment strategy.
Okay, Pascal's wager. How does that apply here?
Well, the core idea is that we know the future is inherently uncertain, right? We simply cannot know for sure whether the market will go up or down tomorrow or next year. We can't control the probability of being right if we try to time things perfectly.
Okay, agreed. The future's unknowable. So if we can't control the probability of success through prediction, what can the intelligent investor control? What should be their focus?
You focus on controlling the consequences of being wrong.
Control the consequences, not the probabilities.
Exactly. The intelligent investor accepts upfront that mistakes will happen. Forecasts will be wrong. Luck will sometimes be bad. So instead of focusing on trying to predict the future perfectly, they focus on insulating themselves from the fallout when things inevitably go wrong.
And how do they do that?
By building in that margin of safety from the start, deliberately buying assets for significantly less than their appraised value, and by maintaining adequate diversification. These actions structurally insulate you from the worst effects of any single error or market shock.
So it's about guaranteeing survival, ensuring that even with mistakes, the overall results are sound.
It guarantees that sound investment principles, consistently applied, will produce generally sound results over the long term, regardless of the market's short-term craziness or your own occasional bad calls. It ensures you can stay in the game. So the question really, for you, the listener, to ponder is this. What specific controllable action can you take today? Maybe it's rebalancing your allocation back to your target. Maybe it's refining your checklist for buying stocks. Maybe it's finally setting up that automatic dollar cost averaging plan. What action can you take to ensure you are firmly on the right side of this investment wager, to control the consequences?
A really profound thought to end on. Control the consequences. Thank you so much for guiding us through the essential wisdom of Graham and Dodd today.
It was my pleasure, a timeless topic.
And thank you all for joining us for this deep dive. We'll see you next time.